Hey, everybody. Welcome to This Week in Pre-IPO Stocks podcast. This week, it is just Clint and I. Nick's on holiday and Evan is traveling. So, of course, Clint Sorensen here is the Chief Investment Officer at Wells Shield. It's an outsourced CIO and investment research company. And Clint just wrote a book called The Smooth Ride Portfolio, which is now available on Amazon. So we're going to kind of dedicate today's episode to all things Smooth Ride Portfolio. So it's going to be really cool. I just read the book last week. I think it's awesome, right? So I'm pumped to dig in. But Clint, I thought before we dived into the book itself, we could perhaps do a little like application to the pre-IPO stock space, right? So in particular, there's two pieces of news that came out this week that I thought were pretty interesting and maybe related to value investing, which is one of the themes. So we'll get into the book specifically, but maybe we can hit on these like kind of hardcore pre-IPO stock things first. So in the portfolio, chapter 2, value investing, I'll do a little quote here. Value, how the stock is priced, price compares the intrinsic value of the company. Undervalued stocks tend to outperform overvalued stocks, right? So that being said, my man, Klarna, all right? Klarna, the buy now, pay later payment shop. So they're rumored to have an IPO at $20 billion in 2025. That just came out this past week, that news, right? That's but they have an implied valuation in the secondary market of 8.3 billion. Okay. So this is that I'm trying to dial into the intrinsic value versus the price, right, of the stock. So they're doing $2.2 billion in revenue right now. So that's a 3.88x revenue multiple on the secondary market valuation. Their revenue's up 22% year over year. Gross profit margins 50%. Other operating metrics are crushing it. They also just announced that they are saving. They shifted from human-based customer service for a big chunk of their team to AI-based with OpenAI, and they're saving an estimated $40 million a year by doing that shift, dropping right to the bottom line, right? So, kind of question to you is value investing. Does Klarna I know Klarna is a growth company. It's a tech company, probably one would say, but is it valuable and kind of does it fit under that definition that you laid out in your book for value investing?
Yeah. So the funny thing about like you read out the definition of value investing, right? So it's all about its intrinsic value, and that has to do with how fast is it growing, are margins expanding or contracting, right? What's the trajectory long term? What's its peers trading at? There's a number of variables that go into calculating what the intrinsic value of that company is, and just based off where it's trading in the secondary, what you had mentioned, versus its revenues and its growth rate, I would say, and its peer group, I would say that's pretty cheap from a value perspective. The thing about the book is we coupled value investing really from a macro level to help individual investors kind of come up with a framework for making decisions. And then the second thing that I referenced was the business cycle. I think the business cycle is really supportive of this piece too. And then the third thing would be the trend. I'm not going to talk about the trend of Klarna at the moment because obviously the trend's been down. But I think as you're starting to see from a growth trend perspective, it's elevating as well. So the business cycle, I think, is going to be more supportive of this as you start to get leading indicators, which we're seeing now improving, right? As leading indicators start to improve, as inflation most likely improves with that or escalates with that, I think that it offers up a big use case for consumers to leverage these type of products to continue to consume at the level they're consuming. So I think that it makes a lot of sense, and I think that they've got a lot of growth, and most importantly, I think they have margin expansion in front of them. When you start to incorporate AI and the productivity that this type of application could get from AI, the sky is the limit. And I think I love hearing that they're already leveraging ChatGPT for these consumer chatbots, because I think probably a majority of their questions could be answered 90+% with a chatbot, which is pretty incredible.
That makes sense. Okay, so that's interesting, and I have a ton more thoughts on that, but maybe we'll get back to kind of the smooth ride portfolio when we talk about the book specifically, because that was an interesting how you answered the question. So on the other side, though, perhaps maybe we can throw another pre-IPO company at you. So Deel, which is a kind of an HR. If you're a company, you want to hire some employees that are international, right? Deel will come in and make that super simple for you. They've dialed it in, all the regulatory regulations, both on the international market where the employee might be and also in the United States. And payroll and everything else that you might need to think about. They just make it super simple to make that higher. So they're at a $13.2 billion implied secondary market valuation. So this is perhaps the other side of the value coin, right? They have a $400 million recurring annual revenue. They've been profitable since September 2022. They have $600 million in cash on the balance sheet, right? So that's a 33 times revenue multiple versus like Klarna, which was at 3.8. So that's a much different revenue multiple. So perhaps
Yeah.
not a value play, but maybe the business cyclical might be perhaps the
Yeah, and
case.
the trend, right?
So what
Because
are
this
your
company's been
kind of your
trending
thoughts after hearing some of those
positively
statistics
for
around
a long
Deel?
time. And momentum, which is, if you think about what's defined trend, there's really two different ways to define momentum. There's time series momentum, and then there's relative momentum. So time series momentum would be something just keeps going up, right, or down, right? Higher highs, higher lows. That's a great way to define time series momentum. Relative momentum would be how this company does relative to a peer, relative to the broad market, relative to cash, bonds, whatever you want to compare it to, and then measuring how it performs relative. If you look at Deel's been one of those few bright spots in the pre-IPO market. I know we talked about it on the podcast before. So I think it's trending very positive, and it's got when you start to see improving fundamentals from an economic cycle perspective, I think it benefits that company as well. And they're obviously commanding a premium, possibly for those two reasons, but definitely not a value play, right? So I think that's why the smooth ride portfolio we separate into thirds.
Yeah.
Because valuations, right? If I want to be a value investor, if I want to channel my inner Warren Buffett or my Seth Klarman or whatever, at the end of the day, I'm going to be oftentimes wrong for a really long time because valuations count on mean reversion. Mean reversion takes, according to GMO, takes on average 12 years to materialize. So who wants to deal with all the FOMO of being out of something? Or as Howard Marks said, you can't be a disciplined investor without being out of stuff that is going up, right? At the end of that, I'm paraphrasing, obviously. But being a disciplined investor means sometimes that you're passing on things that go up and make people a lot of money.
Yes.
And that's very difficult to do for individual investors. So it's, I always say you got to complement that with time diversification. So you got business cycle, which works over a 2 to 8 year period. And you got trend. So momentum works over about a 1 year period. So I think that complements and builds a more comprehensive strategy than just one or the other, but largely just due to behavior. They all work independently on their own, right? So have fun picking one or the other, or one or two of them, right? But they all work individually if you test them. And that was kind of what we went through, or what I went through in the book. But put together, I think it gives you a better ride for an investor, because all investors are really looking for that smooth ride. Even though I'm not, I want all the volatility. I'm a trend follower through and through. Period. That's all I do. But if you're a individual investor, a lot of times that smooth ride is what you want. So that's what I sought to optimize for in the book.
Very cool. Very cool. Okay, so let's get into the book, because so first of all, I read it this past week. I loved it. So hats off to you, because as you can imagine, we live into this space, and there's a lot of people that write things and it's super complicated, right? This book, I felt, is easy to understand. You can be a beginning investor, or I even think a sophisticated financial advisor, institutional investor, and get some value out of this. You broke down some really complex topics and made it digestible, right? And so I appreciate it. I often find times when you take complex things and try to make them simple, it's actually more challenging, right, than just
I had
talking
the best
about
person.
the details of it.
Yeah, so I had Madison Fitzpatrick is who helped me with the book, and she's the reason it was digestible. So she had a very limited financial background, and what she did was she would pull it out of me. So I'd go through these topics, and she would help me get them onto paper, right? So she would interview me. It was a very structured process. Actually, we were finished. I was finished in May of last year. It just takes a while on editing and all the other stuff.
Sure.
But we worked together on this for probably 3 or 4 months. And she really did a great job. So I got to give her the compliment, because that was what I said initially. I was like, look, when I wrote most of the papers I write or whatever, they're for a financial advisor audience.
Right. Yeah.
So they have this background knowledge, and I get lost in the the mix of all this jargon, all this nonsense, right? And so she was really able to take our investment framework that we use with financial advisors in the wealth management space and translate it for an individual investor, because that's what I tasked her with. I said, hey, Madison, I really want to write this so that someone graduating college that knows nothing
Right.
about investing could pick up the book and then apply it. So that was really what I was
Right.
after, is that application process. So I think
Well,
she did a great job nailing that one.
Well, kudos to her, but I would offer this too, like having read this, and I've been around a little bit, right? I actually think it's great if you're in venture capital or private equity or a financial advisor. Like I think it's great for that too. Like if if you're not familiar with some of these topics like multi-factor investing and how it fits in a portfolio or how you would apply it in a portfolio, right? I mean, this is a good entry point. And then I mean, like, look, if I'm a financial advisor, I want more, obviously I could probably call you, right, and have
Exactly.
a conversation with it and go deeper, right? But it's a really interesting, thoughtful, and of course the asset allocation component of it is interesting too. But so that being said, let's like get into this a little bit if you don't mind.
Yeah, let's
So
go.
so I'll do my best to summarize it, right? And then I'll ask you a whole series of questions, right? But
Love it.
maybe before we get into that, just so you kind of just described. So the reason that you wrote the book is was that the reason why you wanted put something out there for an early investor so that they'd be able to understand how to implement this type of a portfolio? Could you maybe just give
Yeah, I wanted to
just
put it
give a
out for a
30 seconds?
non-professional investor, right? So
Okay.
they don't necessarily have to be a new investor, but I wanted it to be digestible for a new investor. A
Smart.
non-professional that wanted to figure out, they knew that every client always comes to the advisor. They want all the upside, none of the down. But really what they're saying is they just want a smooth ride, right? They
Yeah.
work their life for this money, or they're working their lives for this money. And they know that they either have a purpose for that money, hopefully, or they're saving for retirement, or whatever the goal is. It's important and it matters to them. And money is really important to helping people accomplish what they want in life, or get what they want in life, have the experiences they want to have in life. It's just, they say money makes the world go round. I know a lot of people that makes them cringe, but it really does, right? So ultimately, we're
Yeah.
not taught in school how to even balance a checkbook or any basic financial
True.
literacy. Like, it all comes
It's true.
after school or during school for you reading these type of books. So I've seen a lot of books on financial literacy and basic financial planning, and great, right? But what I wanted to come with was, hey, here's an easy investment approach that you can apply with ETFs, right? You can do it yourself. It's not hard, and it'll give you a good investment discipline to sticking with the portfolio, because I believe that risk is the probability of not reaching your outcome, not
Mm-hmm.
deviation from the S&P or volatility or whatever.
Right.
It's the probability of you not reaching your financial outcome. And so if you have a financial outcome and you're in a portfolio that doesn't really fit you personally or behaviorally, you're more likely to abandon it. So I believe
Right.
that I wanted to write a book that would give investors hopefully a path to finding either, spark their interest and help them find a system that fits them, or, because all three of them work, like I said, on their own, or combine them and run a simple method for saving and investing. And so that was kind of where I was at with that, saying, hey, this is what we teach advisors to do. Obviously more complicated. We're using private investment vehicles. We're not just using three areas. It's not always a third, a third, a third. Like, there's different ways we mix and match it per clients, per advisor. But I thought this was a very simple way to just say, hey, here's something you can start from and implement today while you're saving, while you're investing, and hopefully it'll give you the smooth ride you can stick with.
I love it. I love that. Okay, so let me just do my best to summarize this in 2 minutes, just because we're doing a podcast here, right? So smooth ride portfolio, it's a third value investing, a third business cycle investing, and a third trend following. Your recommendation, or you gave a couple different recommendations on how to implement, but using ETFs was one. If you're kind of I'll call it a an affluent investor, perhaps, right? Or an investor that likes liquidity. You could also use um, uh, alternative investments, right? For each of those respective buckets as well, right? So You talked about how to, the frequency of rebalancing the buckets and the like, also in the book, right? So it's kind of a very simple, I think, a very simple, elegant portfolio construction, and also in kind of the thought process, investment thesis behind the portfolio, right? So that's one. And then two, to your point, which you mentioned a couple of times, the whole purpose of the smooth ride portfolio is you actually get better performance, and then you have significantly less max drawdown and volatility, right? So easier to sleep at night, and to your point, higher probability that you'll actually accomplish your risk, because you won't, or your goal, right? You won't do something silly and get out of the market when you shouldn't get out of the market, right? So is that a fair summation of the book?
Perfect.
Okay, cool. All right, good. All right, so then like you talked about the importance of the investors, right? But let me ask you this. So you talked about that a lot, so I won't ask that question again. But you gave an example of an advisor in the book that did this, right? Where they implemented the smooth ride portfolio, and it did wonders for their business. So maybe you could talk a little bit about that story and how you think this approach, where you kind of, you know, minimizing the max drawdown and volatility of the portfolio, can actually be helpful to advisors.
Yeah, so it's really about the implementation of the investment framework, right? Because that's where this all started. So our investment framework that we leverage for our advisors and their clients is centered on valuation, so expected returns, which gives us a really big view of, hey, where are the best areas of opportunity long term, and how do we make sure that the portfolio can at least move there at some point? And we know that that drives long term returns. So we kind of want to have an eye on where the opportunities are. So today, those opportunities are in real assets or financial assets, value over growth from a style perspective, international over domestic. But none of those things are trending positively on a relative basis, right? So you don't want to be overweight those areas now. At least we aren't, because of that reasoning. So then we move to business cycle and Fed policy. And business cycle is just, hey, what's the direction of leading indicators? We're not calling recessions. That stuff is useless while investing. And that's why I never want people to get anchored into that. If I say leading indicators are declining, it's because they're declining. So if I say the business cycle is slowing, it's because growth is slowing. I'm not here to debate landing discussions or recessions or what's going to happen tomorrow. I'm just simply making an observation of where the business cycle is from a growth and inflation perspective. So we use that. And then we leverage Fed policy. How does the Fed respond to that? How's monetary policy as accommodative? Is it moving towards accommodation, or is it moving towards more of a tightening policy? Where is it on the spectrum, right? And you can be red, yellow, green, like a stoplight. So positive, neutral, negative. And that's negative as it relates to
Right.
kind of return expectations. And then last thing, you look at trends, so momentum, right? So trend following, we're looking at what's the momentum in a variety of different assets. So every week we publish a trend monitor, thanks to Michael Melisinos, who you've met before, that just goes through every single market he trades and is in a positive trend, negative trend, what changed, right? And so we understand that that's very important to kind of tracking the trend of these assets, because that gives you a lot of information. Price is very important. And so when the advisor that we referenced, he embraced that framework fully. From the time he started working with me in 2017, he embraced that framework, and he intertwined it with his planning approach, and it became his way of communicating decisions to clients. And that is what worked in terms, in my opinion, of multiplying his business. Not only is that he's a great advisor, he works really, really hard. This is just a contributing factor. We work together, right? But and he would say the same thing, but he embraced this, and it gave him a newfound framework for making decisions, which built confidence with his clients. Even though sometimes it doesn't work out, right? You're not going to always outperform the S&P. Like following the framework last year, pretty boring. And if you're following the process to a T, you're going to be underweight the S&P 500 because of valuations. So you're going to trail, right? But having a process, implementing that framework, having that kind of arm him for client meetings, it's something to stick to and fall back on and be his anchor, has worked tremendously. I mean, it's been incredible to watch him grow. And you know him very well. But it's been incredible to watch him grow and thrive. And he embraced it. If you think about all the advisors I've worked with over time, it's been hundreds. he's the one that did every piece of homework, learned everything he could about the framework. He really dug in deep.
He bought in,
And
yeah. Right.
yeah, so that was that. I've seen it work, right? And I've seen other advisors who it works for as well, right? He's not the only one. He was just a case study that I referenced, but there's been several advisors who have implemented with a lot of success with their clients, and I think it's really important to have a framework, not necessarily this one, but to have a framework.
Right. But Clint, that what I found really compelling about it though is the behavioral aspect, right? So he implemented this philosophy, right? Smooth ride portfolio philosophy with his clients. They had more confidence. There was less because of less volatility. There was less like emergency phone calls, which I'm anticipating freed up a lot more of his time to then go out and prospect to grow and drive new business. Like to me, that's what's having worked with advisors for so long. The most interesting solutions or products to help deliver to advisors are ones that help them grow their business, help them recruit new advisors, or help them drive new assets or more share of wallet or new families into their book, because that's more revenue for the advisor, right? Like switching out one large cap growth fund for another large cap growth fund doesn't make the advisor any more money, but helping them get a new client, makes them more money, right? So like that's like kind of the business of wealth management or business of being a financial advisor. But that like perhaps you could talk a little bit about that, like that eliminating that kind of volatility reduces noise with clients and then allows advisors to free up time to go and grow, right? Is that
Absolutely
kind of a big
absolutely
part of what you're doing here?
Yeah, the whole part of the process is about building a behaviorally palatable portfolio. It's not mathematically optimal, right? Because then you're optimizing to what? It's saying, oh, I'm going to optimize mathematically to outperform the S&P. Okay.
Yeah.
Well, David Harding, I forgot, he was from Winton. I don't know if you caught this interview, but a while back, but he said he was going to launch. He knew with mathematical certainty how to outperform the S&P. And it was just, I think he was going to do it through random selection of securities within the S&P 500. And it was the way he was weighting them. I forget the exact thing he said, but it was the punchline was he was going to randomize the selection of the stocks within the S&P 500. And so you think that's a pretty fascinating concept, right? So your math, but the S&P 500 is not the client. And actually, and I think any advisor should understand this, the client really doesn't want the S&P 500. And that was why I wanted to come up with an alternative. Like I see all this advice and I'm not knocking it at all, right? It would work. Buy and hold works. It has worked. It's done phenomenal. We live in the greatest country. We've had the greatest stock market. I think I featured a study that ended in 1996. We were the only stock market with positive rate of return after inflation in existence. So think about that. That's pretty wild. And I feature that study in there again. It was an old study, but I just thought it was just interesting to look at. And so I'm not knocking buying and holding the S&P for forever if that's your style. But most clients, and I would venture to say over 80% could not do that. They could not do that because at the end of the day, if you look back since 1871 at the Shiller data set, you've had 5 declines over 50, 6 declines over 50%, 4 declines over 60% in that time frame. Looking at the Shiller data set of the S&P 500.
Yeah, I mean,
no one would ride through that.
Well, I mean yeah. So Clint, I mean, I think that's the interesting thing about academic research versus real life investing is you have the behavioral aspects too, but you also have taxes, right? So there's the other thing. There's other things that come into play, right, with humans. Just like I mean, we're in the alternative space, right? So like we talk about what happens with pensions, endowments, and foundation who don't pay taxes and have an infinite investment horizon, and individual people who do have to pay taxes in most cases, right? Unless they have an IRA, but most of their money for especially wealthy people is not in their IRA account and die, right? They don't have an infinite time horizon. So they have to have like some kind of shorter investment cycle for these alternative investments. So like what you're saying like really resonates. Like, and I see I see the value in a smooth ride portfolio. It makes a lot of sense to me. It really does.
Yeah. Yeah, think about this stat. Like the Fidelity does they look at all their accounts and they see the best performing ones, and they're the ones that have been left alone or the ones people have forgotten about. That's because they didn't get pushed to making a bad decision behaviorally. They
Yeah.
allowed it. They allowed the most important thing to investment success to work for them, and that's time.
Right. Yeah.
And that's what I tried
Yeah.
to create here. No one wants the S&P. They wouldn't ride through the S&P. That's why most of the investors underperform the funds they're in. That's why there's
Yeah.
that. What's the? It's the Magellan Fund myth. Have you heard about this? I don't think it's true. Somebody said it's not true, but I'm sure that the average investor in that fund drastically underperformed the track record of that fund. But there was a rumor running around. I saw an article that someone featured that fund, that the average investor in that fund actually lost money. I said, there's no way
I believe
that's
it.
true. And I heard that it's
Yeah.
not true, but that was an article. There was an article out there saying that that was the fact. I don't think it's that dire, but I guarantee you that a majority of investors in that fund underperform that fund.
Yeah.
And
Because they bought. So
I
I
think we
totally
get so
understand.
wrapped up.
Yeah.
Yeah, you know what I mean? We get so wrapped up in these big numbers, but if you can't stick with it, you can't invest in it. And that's one of the hardest lessons I've learned educating advisors. I'm a big trend following fan. 100% trend
Yeah.
following all the way, right? Like Jerry Parker says, trend following plus nothing is the best investment strategy. In my opinion, for me, trend following is the most optimal investment strategy, but clients can't ride it out. And it's all
Yeah.
about the reason they can't ride it out is because it doesn't look like the S&P. It doesn't look like what they're constantly being inundated with on financial media. And so they can't stick with it on its own. And value investing, same reason. We talked about that, right? Why you can't stick with value investing and say, hey, yeah, I tried to create a way to combine these different disciplines to give you enough noise, but not noise in terms of trading or movement or
Right.
activity to keep you in your seat, right?
Yeah.
This for this dopamine addicted society, people like me, right? They're like addicted to my phone.
Yeah.
So yeah.
Okay, so let me ask this then. So you do in the book you do talk about using alternatives. So if you're a high net worth investor, you can use alternatives to get exposure to value, to get exposure to business cycle, right? To get exposure to trend following, right? So the question I did have for you though is, how do you think about? So I go out and I do this today, right? I have my three alternative positions that I've now put into each of the buckets, and now they're running. How do I rebalance across those three buckets, or do you rebalance, or you just kind of like let them run out, right? How do you think about rebalance across value, business cycle, and trend following kind of over time?
Yeah. So in alternatives, obviously you gotta do that based on liquidity parameters within the funds you're invested in, right? So
Mm-hmm.
that's where it becomes a little bit complex. And also you can incorporate other asset classes, right? So I talked about this in the Talmud portfolio on our website, where we did a very similar approach to the smooth ride. It was literally with the exact same reasoning. I was just doing it for a private market investor. So we have a third in trend following, we have a third in commercial real estate, and we had a third in private equity and venture capital. And
Okay.
the reason why is I saw some opportunity, obviously, in venture capital from a value perspective. Saw some opportunity in commercial real estate when we published it because it was the sector that was starting to get hit. So it was another similar approach to looking at this lens, but it was a buy and hold approach, and then we just rebalanced annually. So there's so many different ways you can create a smooth ride portfolio. It doesn't have to necessarily just be applying valuations, business cycle, and trend, right? I think that's the lens you should look at your opportunity set through. Valuations, for instance, we started talking about this in 2022. Venture capital took a bath, right? So they're very attractive from a valuation perspective, right? And they've improved obviously through last year, but we haven't had that business cycle really supportive of venture investing yet to where we're willing to lock up capital for 10 years
Mm,
for a big chunk of the allocation. So we might
sure.
dabble, but we're not willing to go overweight. And I think
Sure.
those are the nuances that really do require an advisor's assistance, or require, give me a call or whatever to walk through kind of how would I reason through that. For the average investor, it's not really applicable. But I think it's really important to look and try to align the environment to support the thesis. So if venture capital looks attractive from a valuation perspective, I need the trend to be positive. I can follow a venture capital index. I can follow like the 8 view index, see when that trend's moving positive. boom, that's supportive. I'd want a really long-term trend there. And then I can look at the business cycle. Are we in a recovery or an expansion? And preferably an expansion of business activity in the United States is what I want to see, which means accelerating above trend growth, because you have the ability to wait, right? So those are some of the things that I would look at for venture capital and some of the private market investments. I wouldn't just say, hey, here, let's just throw these three together, never rebalance them, set them and forget them. I think it's important to kind of look at every opportunity through the lens of that framework. And then same thing with valuations, right? Like valuations right now are very compelling in real assets. You and I are talking about this over text, like electricity, energy, all these scarce real assets, really, really attractive. I mean, it's incredible, especially relative to the S&P. What about REITs relative to the S&P? They're down to below 2009 levels on a relative basis. What about international and emerging markets? China. Like when you start to really look at value, there's a ton of opportunities, but I'm not saying go overweight a value manager in those spaces right now. You got to look within the context of what are the other components saying. And I think that's what gives you the smooth ride. There's always a check and balance to making decisions instead of just saying, hey. Now, I did make it easy in the book because we're in ETFs. So in ETFs, I can buy a quantitative value strategy, or I can follow the value strategy, or the strategy I followed is really simplistic. It just says, hey, let's say your equity piece is going to be benchmarked to the 60-40, or your core allocation is going to be benchmarked to the 60-40. We just took a third and we said 60-40 is your benchmark. So when you have high valuations, you go to 40-60. When you go low valuations, you go to 80-20, and you're 60-40 most of the time in the middle two quartiles. Very simple method for adjusting your portfolio, not a lot of adjustments. And then for the business cycle approach, we just said, hey, if leading indicators are expanding, you're going to be in momentum. You're going to be in high beta stuff. When leading indicators are declining, you're going to be in low vol. It was a very, very simple approach to just using it. And then we show you an automated way where there's several ETFs that we're uploading on the website now. We had to get some disclosures that show you, hey, in these ETFs, they do the work for you. They rotate factors for you based on the business cycle. And then the same thing on the trend following side. Now there's trend following ETFs by some of the greatest trend followers ever that have ETFs that trade all these different markets that you can just put into your portfolio. So that's what I'm launching next, is just to say, hey, go to smoothridebook.com. I think smoothrideportfolio.com is coming to that same, it'll point to the same place. But on there, you'll have an ability to simply automate. Just say, hey, here's what I want to do. Open up your account wherever you want. We'll tell you what ETFs to buy. Very, very simple. But it's not that simple when it comes to the private markets. You got a lot of more nuances there.
I love it, man. Well, listen, congrats. I know this isn't your first book. I think it's your third, if I'm not mistaken. Maybe
it's my third. I've only published two, though. You can see one over my shoulder, and then the other one is on my other shoulder. So,
all right,
good. They're very similar. Yeah,
congratulations, man. I love the book. I think it's great. I think everyone should go out and grab it. I'll put the link in the comments there when we post this and everything, so people can get a hold of it. But folks can also go to Amazon, right? It's if they go to Amazon and they
Walmart,
look,
it's on
if
Barnes
they search
and
for
Noble,
the Smooth Ride Portfolio, it pops up.
And then you can also go on smoothride.com and we send out a free chapter. So feel free to go to smoothridebook.com. Send out a free chapter. And also Talmud portfolio. That was kind of a new addition I did last year. Yeah. Last year, because I'd written the Smooth Ride portfolio back in 2021, finished it in early 2022. And when I wrote the Talmud portfolio, it was kind of a very similar approach. Let's take a very easy allocation method, third, a third, a third. I saw really some great opportunities were going to emerge in private real estate and then in venture capital. So we included venture capital and private equity in that. And then we have trend following, of course, is the core. And it's because that's really the smooth ride. If you think about it, the trend following piece of the portfolio is what gives you the smooth ride. It's that adaptability, but clients can't handle it enough. So I started first with that. I said, okay, if I'm going to allocate my money, what am I going to do? I'm going to put 100% in trend following. Well, for me, that doesn't give me enough pop. So I'm going to want something else. So I like the business cycle part, right? Because I could say, I want to go into momentum or venture or whatever. When the business cycle's supportive of that. When it's not, I want to be more protective, be in lower volatility stuff. Where some investors say, yeah, trend following is great, but I can't handle it because it doesn't stick with the S&P. Well, you have a piece
Right.
in there that rides the 60/40. So I think
Right.
there's a
Right.
ton of, if you really think about it, the thing that smooths it is the trend following component. So we did the same thing in the Talbot portfolio. So check that paper out too. That was wrote that. I thought about doing that as a book as well, but it had been too redundant, I think. So I thought about doing that as a book this year. But check that out, Talbot portfolio. And if you want, Aaron, I'll send you the link so people can just grab it through the chat.
Well, I think it's awesome, man. Congratulations on the book, and I'm looking forward to reading more of the stuff. I read all your research every week, right? And the book was great too. So, at any rate, congratulations, buddy. Hats off
Thanks,
to you.
man.